This is a big update. We've been planning here at FitBucks and Neo Home Loans. We've been planning this real estate update for this time period for what, Josh? I don't know, like a couple of weeks now. And it just happened that some major news just got dropped. Stock markets are down like 2.5%. What does all this mean when it comes to real estate? Well, that's why we're here doing a real estate update. Josh, it's fun as always. Welcome back. Great to have you. How's your summer been?
Been super fun, buddy. We've had a great time. We're catching a lot of fish with the kids, doing some mountain biking, and just enjoying the great outdoors here in Park City.
Yeah, I'm jealous because it's a little hot here in Texas, so
Get
not
it.
coming outdoors too much. But we got a lot to talk about, a lot of exciting stuff. Number one, like I mentioned earlier, the stock market's tanking. Why? Is because the employment report came out basically a few hours ago. So as like I said, this is a real estate update. So what does this affect on real estate? What was the news anyways? What's the effect on real estate? I'll hand that over to you, Josh, let you dig into it and go from there.
Well, as you said, Joe, you picked this date a couple of weeks ago, and I might rename you here on Zoom Nostradamus, because wow, I mean, the fireworks that have gone off in really the jobs market that is coming to kind of a crescendo today with some really drastic moves is an exciting day. This is going to be an incredibly educational session. We're going to get into some fundamentals of what moves mortgage rates, what indicates a recession, either leading into a recession or perhaps we're already in one. And I couldn't think of a better day to have this live event. So thanks for having me, my friend. And if it's okay with you, I'm going to just share my screen and jump into the things that I've been watching this morning.
Absolutely. Let's do it. I'm anxious to see it because I just saw the stock market tank this morning. I've been on phone calls all day, so I didn't get to dive too much into the numbers. So this is going to be the first time I'm seeing some of these numbers too. So I'm ready to be in some shock and awe, and let's dive into it.
Yeah, there's no PowerPoint presentation today, team, because this is all live time. So here we go. All right, well, let's start by getting a breakdown of the payroll report that just came out this morning. And I don't know if you know who Lynn Alden is. Lynn has written a book on monetary policy and the difference between fiat currency and hard currencies. She is an economist. She is an incredible economic forecaster, and she is someone that I follow very actively on Twitter. I've read her books. I listen to her podcast. She's brilliant. And so, and she's not usually funny. So this morning, her post on X was the technical term for the payroll report, which is essentially an employment report, if you're not familiar with it, that just came out this morning, is a dumpster fire. And we're really seeing the jobs market slow. And so let me just go over the numbers really quickly. They call this non-farm payrolls. It's a technical term. It's just a way of measuring the number of jobs, whether they're expanding or contracting. So in the June report, there was 179,000 jobs added. The forecast for the July report was 176,000 jobs added to the economy. Well, the reality was there was 114,000 jobs added to the economy. This is a massive slowdown, and I'm going to give you context in the next one of the next tabs here over a longer period of time going back to COVID, so you can really put this in context. But this is a major miss. The job participation rate numbers. Previous was 62.6, now 62.7. So you're seeing people seeking jobs. There are actually more people out there trying to participate in the labor market. The private non-farm payrolls, so this is private industry, meaning excluding government jobs. Expect the last month in June, 136,000 jobs added. The forecast was 148,000. So the forecast was that the private payroll number would increase by 12,000. In fact, it significantly decreased. And the employment rate, this is the kind of the important thing that the Fed watches and references frequently. The previous unemployment rate was 4.1%. The current unemployment rate now jumped to 4.3%. And what's important to understand, to put this into context, is that in this cycle, this jobs or business cycle, the unemployment bottomed. I think the number was 3.4%, if I remember correctly. And 100% of the time, if you go back to the 1960s, 100% of the time over the last 60 years, when the unemployment rate bottoms in the cycle and moves higher by at least 0.5%, you have an economic recession. And that can be scary. We can talk a little bit about, we will talk a little bit about how that affects the housing industry. But this is a pretty clear signal this morning that we have moved from a really strong economic expansion going back to the end of COVID. Strong might be arguable, but the stock market has certainly been strong, to what indicates we may already be in a recession. So let me just pause there for a minute, Joe, and let you add color commentary.
Yeah, I know a lot of people that watch our podcast, listen to our podcast, watch our YouTube channel. You know, they know my background is primarily investments, and then I went in and built FitBucks, all that type of stuff with the financial planning stuff. But investing was where I had my start at, and those two numbers that we used to look at was the labor participation rate and the U6 unemployment. So like the typical headline employment that they always like, the one that's at like 4-point-something% right now.
Let me pull that back up, Joe.
Yeah, we don't ever, like, I would never even look at that. That U6 unemployment rate, we used to nickname that the real unemployment rate. You know, 7.8% is pretty damn high. But that is, you know, a stark difference. Again, that's up, you know, I'm doing mental math in my head right now, but that's up about 5% over, you know, the previous month. That's a pretty drastic increase. So yeah, it's done, like, not good numbers back into a recession, I guess, right? So, but yeah, I was going to talk about the treasury yields next. Is there something else you wanted to add in on the unemployment report, or you want to go straight into the treasury yields?
I just want to show one other thing, because I wanted to give a little bit of context here, because when somebody says, okay, great, well, we thought there was going to be 176,000 jobs added to the economy. There's 114. It doesn't really give you a lot of perspective, right? The question is always compared to what? So let's compare it to kind of the historical numbers here. Let me try to move this off my screen. There we go. Okay. Sometimes Zoom covers part of the slide. So this is U.S. non-farm payroll. And don't get distracted by the name. It's just a way of measuring the number of jobs added to the economy. Okay. There's a lot of ways to measure it. This is the one that the Fed really puts a lot of, impetus behind. They really watch this carefully. So you can see back in 2020, okay, we had COVID. All right. We had a huge decrease in the number of jobs, right? Everybody was laying off. We all remember what this was like. But then you saw the number of jobs added to the economy each month just absolutely skyrocket. If you look at, this would have been June of 2021. This would be July of 21, when you had almost 1 million jobs, 900,000 jobs, a little more than 900,000 jobs being added to the economy in 1 month. Boom, massive expansion and rebound in the economy because of all of the monetary stimulus that was going on and the rebound that was happening. Well, if you look from this high point to where we are today, you can kind of just see this downward trend line. And now we're down to 114,000 jobs added to the economy. That is a clear-cut sign that the economy is slowing and we're likely entering into a recession. And then I'll just show one more thing here. I want to just introduce everybody to what's called the SOM rule, because it is incredibly accurate in predicting recessions. So the SOM rule, for those who don't remember, is that the recession is effectively already underway if the unemployment rate based on the 3-month moving average. So this isn't just on July's number. This would be July, June, and May. If you add those up and you come up with a 3-month moving average, if it rises by 0.5 percentage point from its low of the past year, then you're already in a recession. And that's what just happened with the unemployment rate surging 0.6% from the year's low. So the SOM rule says if you have the previous 3 months average unemployment rate up 0.5%, you're already in recession. There's 100% accuracy with the SOM rule going back, I believe, to the 1960s. But you can see we went from an unemployment rate down here in the 3 whatever it was, 7 range, and now we're up to the 4.3 range. So we've triggered the SOM rule. So I just wanted to point that out, that we're kind of building the case here that we're headed towards a recession. And then we're going to talk about how that's going to actually impact mortgage rates and the housing market.
Yeah. With all that said, I mean, I talk about treasury rates a lot from multiple standpoints. So like you said, it affects the mortgage industry. It affects the like student loan refinance industry. It affects, I look at a treasury yield, like those of you that are FitBucks members and you get our monthly economic updates. I talk a lot about it in terms of predicting economic recession. It's one of those indicators that's like, hey, one's coming. And we've been in not a really good situation for the last probably 2 years, 1 to 2 years. But I won't go into that yet. Let's just pull it up right now. Let's just go talk about what's going on in the treasury market, because that is, going to affect mortgage rates coming up here over the next month or two, and probably going to be affecting maybe more going forward. So yeah, what do you have on the treasury rates?
All right, here we go. So this is a little technical, but let me try to make it easy for you. This chart and each one of these this is called the Japanese candlesticks. Each one of these charts, these little graphs, these little bubbles, this green or red bubble here, it represents 1 day of trading in the US Treasury market. This is effectively measuring what is the rate if I'm going to lend to the US government. If the US government is going to borrow from me, they do that by me purchasing a treasury bill or a treasury bond. And what is the rate, or also called yield, that the US government is going to pay me as an investor to lend them money? So they track that on a day-to-day basis, because the market, the bond market and the treasury market moves every day. So we can see, if we go back to, when was this? This was April 26th. Let's just call this the end of April. The yield on the 10-year treasury, that means that the US Treasury is going to pay me as an investor 4.71% for that treasury bond for a 10-year loan. I'm buying a 10-year treasury bond, which means I'm loaning the government money for 10 years. And they were paying a yield of 4.71. Now, if we go from April 26th to where we are today, you can see now we're down to 3.8. So it's almost 100 basis point move, 90 basis point or 0.9%, which is a massive drop in US Treasury yields over a couple month period of time. And what's really why I said, Joe's Nostradamus for picking today as the date we do this interview, is because look what happened over the last week. We went from 4.3% yield down to, let's call it 3.8% yield. That is a 50 basis point move in
Massive
7 days. Like that is the Titanic turning around on a dime and heading the other direction. And what that means is, if you kind of adding all this together, like, okay, what does this all mean? Put this together for me. The billionaires, the hedge funds, the endowment funds are all saying, whoops, the economy is not as strong as we thought it was last week or 2 months ago. The labor market is cracking. That says we're entering into a recession, and people are rushing in to buy treasury bonds. When there's more demand for treasury bonds, then the government can sell those bonds at a lower yield, or they have to pay a lower rate because there's huge demand for those bonds, because treasury bonds are considered a risk-free trade in that the government is guaranteeing that they're going to pay that investment back. Joe, how would you clarify that and make it easier to understand? And then we'll kind of talk about how this relates to mortgages.
Basically, when there's panic in the stock market, people go to treasuries. Treasuries have an inverse relationship with yield, meaning this: treasury prices go up, yield prices go down. So simple supply and demand. you have the same supply, but the demand goes up, so the price goes higher, which means treasury prices drop, which is why in the last week you're seeing that drop. And Josh, to your point, that is a titanic drop. Like it's been long noted that moves in the bond market are very slow. They take time to kind of evolve. So to see that drastic of a treasury yield drop basically overnight, like 7 days is a week, right? But in the bond market, that's overnight. Like that is massive. And then that leads to the next big thing about another recession indicator. Again, this is what I've been talking about in our stuff, is the inverted yield curve. So go ahead and give us an update on that, where all that stands at.
Yeah, so we just talked about the SOM rule, which essentially has a 100% accuracy rate of predicting recessions going back to the 1960s based on an increase in the number of the increase of the unemployment rate. This is another recession indicator. This is going back to I think we're back to like 1976 here. So I'll let you explain this if you'd like to, Joe.
Yeah, so if you think about this, right, if you borrowed, for 2 years, or if you lend somebody money for 2 years, versus lending somebody for, money for 10 years, $1 today is not worth the same as $1 tomorrow. That's the best way you could say it, right? So in order to get compensated equally on the 10-year, you would want a higher interest rate. So like if I'm lending money to Josh on a 2-year loan at like 3%, I might, lend Sally on a 10-year loan at 4%. So there's the typically in a good, healthy economy, the long-term yields are higher than the short-term yields. An inverted yield curve is the opposite of that. And that's signaling a recession, which Josh, on the chart that you have up right now, that's the red is when that is inverted. And then I'll let you go ahead and point out the different, times that there's recessions and whatnot as we follow that curve.
Yeah, and this is a little hard to see. I'm going to try to blow this up just a little bit. I think you can see it a little easier. But you see these like little, can you see it on your end, Joe? These little gray.
I can, yeah, the gray areas.
Mm-hmm. So the gray areas mean recessions. That's the time period that we were in a recession. So in 1980, we entered a recession ballpark January, and we ended the recession ballpark June. So it was a 6-month recession approximately. But what you'll see happen is we entered in what's called an inverted yield curve, where the yield, or the rate of interest is another way to say it, on the 2-year was actually paying higher than the 10-year, which is very unusual. And basically what that means is the 1% of the 1%, the endowment funds, the governments across the world, the hedge funds, they're all saying, wait a minute, there's a train wreck in the economy coming. We're going to flood our money into the 10-year treasury because we think those yields are going to go down, and we want to lock in these higher yields before we get to the recession. So it doesn't tell you you're in a recession. It says there's something wrong with the economy and the economy is sick. But what tends to happen 99% of the time is after you have an inverted yield curve, you enter a recession. So you can see we had an inverted yield curve starting in 1978. We entered a recession in, looks like late 79 or January of 80. Inverted yield curve started here in 1980, back into a recession in 81. Inverted yield curve in 89, entered a recession in 90. Now, this was the false indicator. This is, I believe, the only false indicator going back to the 60s. There was a slight inverted yield curve in 1998. No recession. Yield curve straightened itself out. Then we go an inverted yield curve in 2000. This is the tech bubble, right? That imploded in 2001. Inverted yield curve starts in 2006, hit an official recession in 2007. This one's wild, Joe. Inverted yield curve in 2019, COVID recession, right? I mean, that one's really wild. And then inverted yield curve triggered in 2022. And you would now expect that a recession is coming, and that the billions and trillions of dollars in the global economy have been anticipating this recession since 22 and moving their money into 10-year yields and causing this, or 10-year treasuries, causing this inverted yield curve. And it appears that there should be a gray line right about here.
and it's coming. So in short, before we start talking about, listings and different things that are going on outside of yields and whatnot, when it comes to yields, just looking at that standalone, just let everybody know, like, what does that mean to mortgage rates?
Mortgage
and
rates.
Standalone, what does that mean to affordability of housing and everything that goes into that? Just standalone, looking at that only.
Yeah, great call. Thank you. So if I go back to the yield on the 10-year treasury here, and I'll just show you really quickly, boy, we're almost out of this inverted yield, which usually happens when you enter the recession. It's called a steepening of the yield curve. And usually once you've been in an inverted yield position and you come out of an inverted yield, you're already in the recession. And if you look at this today, Joe, your 10 years at 3.8, your 2 years at 3.88, we're about to come out of that inverted yield curve. So it's just another technical analysis that would say the recession is upon us. But let's talk about how this relates to mortgage rates. Historically, well, let me tell you what it is today. Today, we have a 10-year yield at this moment at 3.82, which means if I loan the government money for 10 years, the Treasury, they're going to guarantee me a rate of return, interest, also called yield, it's the same thing, 3.82% for 10 years. And then at the end of 10 years, they're going to pay me back my principal. There's a spread between the 10-year treasury and mortgages. They don't follow lockstep, like, it's not the same shoe, the same color, one after another in lockstep. It is a trend that always follows one another. So as the yield on the treasury goes down, mortgage rates will go down. As the yield on the treasury goes up, mortgage rates will go up. So mortgage rates have been trending down alongside treasury bonds. And typically, or today, I should say, let me start with that. There's about a 3% spread between the treasury yield and mortgage rates. So ballpark mortgage rates are about 3.82%. If you want to pay points, of course, you could get it lower, but ballpark, there's about a 3% spread. Now, here's the interesting thing. Historically, Joe, you know that the spread between the 10-year treasury and mortgage rates is more like 101.5% and 2%. So in a normal market, we would anticipate if the 10-year treasury was at 3.82, we would expect mortgage rates at 5.82 or 5.5. The spread is what's called blown out right now. And the spread is near 3%. And the reason for that is usually when the people who buy mortgage-backed securities, which is just bundled mortgage loans, they value two things. They value the spread between what's called a risk-free trade, which is buying U.S. Treasury bonds, and what the mortgage rate is. And there's a risk premium there for investing in a mortgage versus investing in what's considered risk-free treasury bills. So there's a risk premium, and that's a profit for them. But there's another profit for them, which is called the duration that they're going to service that mortgage. The longer they think they're going to hold that mortgage on their books, there's a servicing value placed on that mortgage. Well, right now, the servicing value is basically zero because all of these people who are buying these mortgage-backed securities believe that all these loans are going to get refinanced because just like there's an inverted yield curve, which means the bond market sees yields going down, the people who are buying mortgage-backed securities sees the recession and sees rates going down, and they know that all these loans are going to refinance. So if you're not going to hold the loan for 5, 7, 10 years, there's no servicing value placed on that mortgage-backed security. So if they have no profit in the servicing spread, they have to make it up but the spread between the 10-year treasury and the mortgage. So this is good news for people thinking about borrowing money in a mortgage because as rates go down, not only will that improve mortgage as the 10-year treasury yield goes down, not only will that pull down mortgage rates, but the spread should narrow from 3% between the treasury and mortgages back to its historic average of 1.5% to 2%. So we could see mortgage rates drop precipitously. It would not surprise me to see a handle in the fives somewhere between now and the end of the year, high fives.
Yeah. Yeah, no, definitely. And that's actually the big headline right now from the site that I just pulled up is like the Fed waited too long, which that then means rate cuts are coming too, right? So all that feeds into the lower interest rate.
Dude, how brilliant would they have looked if they would have cut a quarter in their Fed meeting just this week? I mean, they would have said, look, we learned our lesson. We think we waited too long to raise rates, but we nailed this one. We're here to support the economy. They just muffed it.
Well, this is what I had a professor tell me back in 2002. The famous quote from the Federal Reserve is, "We didn't get it right this time, but we learned we'll get it right next time." And they're always behind, always. I mean, they were behind going into this interest rate raise, keeping interest rates at 0% for as long as they did, and they're behind this. So it's like, yeah, we'll get it right next time, right? And I used to joke around with economists all the time that I knew. I was like, the reason why they put probabilities on everything is so that they can never say that they were wrong. Because there's always a 5% probability that they're wrong, right? Like it goes the other way. And well, we didn't say it was going to be this. Like we said there was a possibility of it going the other way. Like, so we weren't wrong. So it's a good protection ego type of thing that they got going on there. Anyways, that's my Fed spiel for the morning.
The government's never wrong, right? I mean,
Yeah.
they just, it was a black swan event. Who could have predicted?
Yeah, I just had my probabilities wrong, we predicted 176, jobs being created and well, only 90,000 got created, a little bit off, but hey, we weren't wrong. Anyways, so that's the yield curve, that's the treasuries. There's other news out there too. One of the things that we touch on a lot on whenever we do updates is like listings and inventory. Where's everything at on that for right now?
All right, let's go to the Redfin data center, which I love because it's live time. It's the closest thing we have to live time data. Like when you look at Case Shiller and those types of things, they're several months old. So Redfin's my go-to for live time data. And let's connect the dots here. What we've shown you is several reliable indicators that we are entering a recession. 100% of the time, when you enter a recession, the rates go down, mortgage rates go down, the yield on the treasuries go down because people are coming out of the stock market, as Joe explained, into buy safe bond investments. And that causes the yield or the rate of interest that you would earn as an investor to go down. So think about how that's going to impact the housing market. When rates go down, mortgage rates go down, that makes housing more affordable. There's been a lot of people who've been staring at 7% and 8% mortgage rates over the last couple of years, and then looking at their housing payment and saying, no, thank you, it's cheaper to rent than it is to buy. But when you were looking at an 8% and a 7% rate, and pretty soon you're already looking at sixes, but pretty soon you're going to be looking at low sixes and high fives, those rates start to look really attractive when you were just looking at an 8% 6 months ago. So we would anticipate as rates go down, housing becomes more affordable. We're going to bring some of those buyers off the sideline. Now, it is true that, when you have an economic contraction, i.e. recession, some people are going to lose their jobs. We would anticipate that. But according to Black Knight, they did an analysis on this. For every 1% that mortgage rates go down, 5 million more Americans qualify to buy a home. Now, that doesn't mean that there's 5 million Americans entering the housing market. It just means that it's decreased the payment enough that 5 million more Americans qualify. So as rates go from 8 to 7 to 6 to 5, more and more people who've been locked in their home at their low mortgage rates or locked into renting now have the ability to qualify for home ownership. So just kind of keep that in context here as we go over these numbers.
Yeah,
All
and
right.
as you go into the numbers too, the other thing that you have to realize too, as part of that, I'll throw this out there too, is that there's also a lot of people that are locked in right now at 3 to 4% interest rates,
Yes.
and that they want to buy up, and they've held off because of those 7 or 8% interest rates. They can't afford to. But when rates start getting around 5%, like if I have a 4% mortgage and I have a condo and I want to buy a house and now I can get a 5.5%, the rate's not that drastic of a difference. So now you got those people that are now trying to move up, if you will, that are going to be entering the market as well. So yeah, go ahead.
And you probably saw if if you bought your home in 2019, you've probably seen your home go up at least 50%, in some areas double. So you've got a tremendous amount of equity to move into that move up. And yes, that price is higher, but as you say, when the rate there's less sticker shock. Like going from a 4% rate to an 8% rate is like, slamming on the gas or on the brakes at doing 150 miles an hour. It's just a different feeling if you're going from 4 to 5.5.
Yep,
Yeah.
exactly. So
All
yeah,
right.
go ahead and pull up the charts that you're gonna pull up. Yeah, they're
Okay.
there.
All right. So let's go through. This is just the Redfin News data center. You can just Google Redfin data center. It'll come right up. But what I love about this is it gives you compared to what? So that gives you the last 4 years. Well, I don't know what I did right there. It gives you the last 4 years data. So 2021, 2022, 2023, and then where we are so far in 2024. The left hand of the graph starts out on January 1st. So let's just look at the top here. This would be, let's go to the yellow, which is 2024. So this starts in January 7th of 2024, and this is new listings. So as always happens, listings rise throughout the year because nobody wants to sell their home and list their home over Christmas and New Year's. And then as we get into the summer, you see this kind of peak in new listings. And then the number of new listings has started to go down, which is pretty typical around this seasonal time of the year. New listings start to slow down because most people tried to sell their home here between, April and the end of June. So this is kind of the peak season. But it's interesting to me that it looks like new listings definitely have peaked. I mean, they peaked really over here, and they're definitely on their way down. And it seems like this is going down in terms of the new listings earlier in the year than we've seen before, because the peak was in May in 2024. The peak was in the end of June in 2022 and in 2021. So that's kind of interesting. That just tells us there's not a ton of listings flooding the market with supply. Anything you want to add there, Joe? Feel free to jump in.
No, I mean you're doing a great job. It just, I'm anxious to see what your take is on terms of like the inventory, the sellers listing, the market pricing, and how is this going to affect all of it or impact all of it, I should say.
That's a great point, Joe, because I'm showing all Redfin metros, and real estate is local. So you may very well be in an area where you're going, wait a minute, there's a shit ton of listings in my area. This is national data. So if you want more specifics on your area, just come to the Redfin data center, click on this, pick on your specific area. Let's just pick Amarillo, Texas, and you can get more specific data. But people are all over the country, so we're going to just talk about all metros. Okay, let's go to median sale price, Joe, just to kind of see what's going on here. You can see that median sales price, which I will define in just a moment, peaked at what is an all-time high, because this is 2024, this is 22, this is 23, and this is 21. So home prices essentially continued to go up from a median home price perspective, hit an all-time high of around 396. And now that's come down a little bit over the last, let's call it since June 10th. So the last 2 months. Well, interestingly enough, mortgage rates were on an upward curve through May and actually June and have started to come down. So this, to me, this reduction in the median price is because interest rates were kind of spiking. We got all the way back up to like 7.6, 7.8%. Now we're down in the 6.8% just over the last couple of weeks. So I would expect that we'll see a little more strength in the median price because interest rates are going down. Anything you want to add there, Joe?
No, that is fantastic insight. Like I said, I pull up Austin real fast. I'm
Yeah.
curious now about
Yeah,
what.
Austin is an outlier for sure. So okay.
Yeah,
So
there it
yeah,
is.
look at this, Joe. Austin peaked in 2022 at 574,000, up 24% year over year. Team, real estate should not increase 24% year over year. That is not an indicator of a healthy market. Those who were in their home for 3 or 4 years, good for you, but this is not sustainable.
Yeah.
And look at this, Joe. We went from 574 median price to, well, let's just see where we're at right now. 456. So if you bought in 22 at 574 and now you're at 456, you are not a happy camper.
Yeah.
But I will preface this by saying this. I don't know what the builder dynamics are in Austin specifically. I'm guessing the new construction has slowed down over the last couple of years because of the drop in median price. But I believe the reason why this drop was so precipitous and so fast was because it was absolutely unaffordable. This price at an 8% mortgage rate, 70% of the people out there probably just cannot afford that type of a payment. So you've had two things that are going to regulate to normalize this market. You've seen about a 20% decrease in price there, which is painful. And you're going to see interest rates go down. And as affordability is restored, as rates go down, I think you're going to see a normalization and Austin continue to have decent home values because, hey, people want to leave California and move to Texas. That isn't changing. We just need to restore affordability.
Yeah, and the reason why I wanted to pull that up is one, obviously I live in the Austin area, but two, I wanted to show the audience like why it is so local, how different things
Yes.
change. Because there's also different factors in there too, like you talked about with the mortgage rate. It's also the property tax rate, all that type of stuff. It all plays a role into it. So
Yes.
be sure to know what your area is, especially if you're going to be buying and selling and whatnot. So was
That's
there
it.
another chart that you wanted to bring up on here as well?
Yeah, I think I want to just show I wanted to show active listings real quick and then price drops real quick.
Hmm?
And then I know we got to close this out because I've got a meeting, you've got a meeting. So okay. This is active listings, and you can see that we hit a dang near all-time low. Actually, I think the year before this was the all-time low, but there was only 600,000 listings in January of 2022. And we've seen the number of listings continue to increase. We peaked at 1 million active listings. According to Redfin, everybody has a bit different way of measuring this data, but the trend is the same. And so we peaked at 1 million, and you're seeing the number of active listings go down. That means supply is decreasing slightly, not a lot. We're talking about 10,000 listings here, but it has peaked and it is going down. And I'll just end on this point. If supply is starting to come down and demand, we would assume, is going to go up because every 1% that mortgage rates go down, 5 million more Americans qualify for home ownership. We would anticipate that you're going to see more demand on that limited supply, and that should keep housing prices buoyed. Now, here's the wild card. How bad is this recession? If this is an epically bad recession and millions of people lose their jobs, then that's going to slow down demand for housing. If it's a middle of the road recession where there's not that many job losses, but mortgage rates go from 8% peak down to 5%, that would, you would assume, be a boom for the housing market in terms of demand. And Joe, play devil's advocate here. What do you think I'm missing?
I don't think you're missing anything. I think you hit the nail on the head with that last statement. It really depends on the depth of the recession because you have that unemployment factor that can greatly influence those prices. And again, it's all relative to what market you're in, right? Like, so, San Jose, California, where I grew up in, you can have a massive recession in the country, but because of the way it's landlocked and because it's got international money going into Silicon Valley, then it's fine. Like, you're not going to lose that much. Whereas in like '08, Vegas dropped like 60%. San Jose was down like 10%. It wasn't that bad. If it's a tech layoff, San Jose might get hit harder. Austin might get hit harder. If it's manufacturing, if it's this or that. I know the manufacturing industries right now are hurting. Like, manufacturing companies are really, really, really hurting. I know there is one more thing that I do want to touch on, because we have gotten a lot of questions on this from our audience, and it's going into effect in 2 weeks, which is the new NAR, like all that information about the new. Oh, I'll let you explain it. You'll explain it better because you're knee deep in this stuff every day. So go ahead and take it away.
Yeah. So, the Department of Justice started investigating the National Association of Realtors, and they ended up being a class action lawsuit. And essentially what they've said is that this is an improper business practice, that the seller of a home is essentially, their claims, forced into paying 6%. And then that money goes from the seller to the listing broker. And then the listing broker has what's called a cooperative compensation rule, which was something that was went into effect in the 1990s through the National Association of Realtors, that said that that compensation is cooperatively shared with the buyer's agent. So effectively, what the claim was, the lawsuit, and what the DOJ is saying is, the listing agent and the National Association of Realtors are colluding to manipulate the seller to pay for the buyer's representation, which effectively negotiates against the seller. And there's a $418 million settlement by the National Association of Realtors. All of these, like, Berkshire Hathaway's home services real estate company has paid, I think it was like 40 or $50 billion to settle. The total settlements, more than $500 million in restitution. And as of August 17th, no longer will the cooperative compensation rule be in effect, which means that the commission that goes to the listing broker is not shared with the buyer broker. And if you're a home buyer and you go hire a buyer's agent, the compensation for that agent isn't necessarily going to be paid by the seller. Now, they can issue a concession. It's not going to be listed on the MLS. You won't know what that concession is, and you're going to have to sign what's called a buyer agency agreement with your buyer's agent that spells out specifically what the compensation that buyer agent is going to be paid. But you do not know at that time, because that has to be signed before you go look at the first home with that realtor. You do not know if the home that you fall in love with is going to give any concession to you so that you can pay your buyer agent. So here's the big disruption. Here's how the money used to flow: from the seller to the listing agent, to the listing agent to the buyer agent. So the buyer was never even involved. If you look at your settlement statement as a buyer, you'll never see your buyer agent commission on there. It never showed up. That is now changed, because it'll work like this now. The seller will pay the selling agent, and then if there is any concession to the buyer, the concession will go from the seller to the buyer, from the buyer to the buyer's agent. So you could be in a position where you hire an agent and you agree on a compensation, you fall in love with a listing, and that home has 6 offers on it, and there's no concession to pay the buyer agent commission, which means you as the buyer would be responsible for that compensation. So I just put a link in from the NAR, which is home buyers. Here's what the NAR settlement means to you. If you're thinking about entering the housing market in the next 12 months, you have to read this document. You should absolutely understand it. And then I will just end by saying there's 4 ways to pay the buyer's agent commission. You can have the seller pay it if they agree to it. You can pay it yourself. You can add it to the price of the home, or you can include it in your mortgage. And if you want more information about that, like, hey, wait, I don't have the money to pay my buyer's agent and my down payment. How can I finance this? Reach out to me, josh@joshmetal.com. I'm happy to answer those questions and tell you how it could be financed and answer any other questions about this topic.
Perfect. That will wrap it up for our update. It's fun as always. You know, if there's any other news that pops up, like what happened today, let us know. We'll be doing another update as soon as we get that information out. We will probably, even just on schedule, probably do one more update before the end of the year anyways. But always stay tuned. Be sure to subscribe to the channels, both of ours, Neo Home Loans, Josh, BitBucks, all of us. It's been fun as always, and we'll see you guys soon.